Okay, good morning, everybody. Hope everybody is well this gloomy Wednesday morning, and you're all feeling fine and doing okay. Um, First off, I'm going to go over today the quiz number 2, which you all posted on Sunday. I have yet to post all the grades. I'm still working on them. I apologize. I shouldn't tell you I'll have the grades up by Tuesday, and then because of my schedule and my events, I don't get a chance to finish them all. But I'm about halfway through them, and I'll post them either later today or tomorrow morning. You'll have them this week. But the solutions are posted to Blackboard, and you can look at those solutions accordingly. Remember, this quiz was on chapters 6 and 7. A week from today, April 15th, we have an exam on chapters 6 through 9. We're having our lecture on chapter 8 this week, and chapter 9 on budgeting will be next week. And that'll make up our next examination, which will be posted at the end of class. It's Wednesday, and it will be due Sunday, April 19th. And that's our schedule for the next couple of weeks. I hope you all, again, are looking at our introduction videos every week on Sunday or Monday prior to our week, because it gives you a little idea what we're talking about and where we're headed in that week. One of the key things, as you guys are finding out through all your courses, including mine, is a key to online learning and staying engaged is, first of all, to have a professor who is cool enough to have a virtual background. Check this out. A virtual background. Look behind me. It's a classroom. That's my virtual background for this class. It'll change every week. Now, how cool is that? Yeah, right. Okay. But besides that, let's make sure it's the key to online education is to keep you guys engaged, so you're willing to come on every Monday and Wednesday at 10 o'clock in the morning and willing to start and keep doing the work and read your textbook and do the problems and do well on the examination and quizzes, is to keep you engaged. Part of that is videos, part of that is communicating with you what we're doing, how we're doing it, and to have you stay on top of that, That's why I urge everybody to, if you cannot attend class, let me know, and I will get you the materials. I record the class. This class is now being recorded. At the end of class, I will post this video to our YouTube site, and then you can see the class through YouTube. I also will post the link for the class to our Zoom links file folder, so you can click on the link and watch the class again. But if you miss a class, I don't know whether to record it or not, and that's why you need to tell me. I don't care the reason why you're not missing. We're all adults. But I want to know, if you cannot attend, then I'll record the class and make it available. Again, it's to your advantage to attend class and listen to me go over the problems and let you know about the material coming up. But at the same time, if you cannot attend class, you just let me know. I will record the class and we're off and running. So again, here's our quiz solutions. We had 2 problems to do in our quiz. They had to do with chapters 6 and 7. And here's the work for those quizzes. Here's the solution. Each problem, question 1 and question 2, were worth 50 points. Again, I will post this solutions has already been posted to the quiz number 2 file folder, so you can download. Again, this is a study guide for the examination for a week from today. The question is, DeMont Tax Services produces 2 lines of service: accounting and tax. Accounting-related services represent 60% of its revenue and provide a contribution margin of 30%. Remember, the contribution margin is that mix or that percentage of variable cost to sales. The tax services represent 40% of its revenue and provide 40% contribution margin. The company's fixed costs are $4.59 million. Part A, calculate the revenue from each type of service that the company must achieve to break even. Well, they tell us that accounting is 60% of the revenue mix, sales mix, contribution margin is 30%, Take 30% of 60%, that's a contribution margin ratio of 18%. Taxes is 40% of the revenue, 40% contribution, 40% of 40% is 16%. The total contribution margin ratio for the company weighted by each share of tax and accounting is 34%. If I know that my fixed costs are $4.59 million, I divide that by 34%. In other words, $4.59 million is 34% of our break even in sales. $13.5 million is the answer to question A. What is the mix? I take 60% of 13.5, where the accounting will be $8.1 million, and tax will be $5.4 million. Now, let's say the company wants to make in Part B a desired net income of $1.7 million. What is our profitability? What is the portion of the sales mix for tax to achieve a profit of $1.7 million? Well, fixed costs are 4.59. We add in the desired net income and we divide that by our contribution margin. We must make $18.5 million of sales to make a profit of $1.7 million. 40% is the sales mix of the tax. The answer to question B, 40% of 18.5 million is $7.4 million. So that's the answers to a typical question involving Chapter 6 about what is contribution margin ratio of particular areas of your company. Determine a contribution margin ratio, knowing the fixed cost, that's our break even, and then determining what part they're going to share in profits of a company of sales if we want to achieve a certain desired net income. That's question 1 from Chapter 6. Question 2 from Chapter 7 asks us to determine incremental analysis. Incremental analysis, what if certain things change? What if we decide to do something different? What will be the result of that? Is the incremental analysis going to tell us to do it or not to do it? Felter Company produced and sold 50,000 units of a product operating at 70% of their plant capacity. 70% of plant capacity means that 70% of all resources of the plant are producing those 50,000 units. If the company was operating at 100% capacity, they would probably definitely produce more units. Selling price is $70. Variable cost is $45. Fixed manufacturing cost is $500,000. If we're producing 50,000 units, that's $10 a unit. Total cost, $55 a unit. That means we're making a $15 profit margin, profit per unit of our product. The company received a proposal from a foreign company to buy 10,000 units of Felter's product at $50 a unit. In other words, our selling price right now is $70. We get a special order from a foreign company, wonder if Donald Trump knows about this, is $50 a unit. This is a one-time only order, and acceptance of this proposal will not affect the company's regular sales. Why can they go ahead and do this order? Because they're only operating at 70% plant capacity. They can produce more if they want to. I have a chat question. Cerise, no worries, buddy. Thank you for showing me that. That's okay. Thank you, Cerise. All right. So to do this one-time order, should they? The president of Felter Company is reluctant to accept this proposal because he's concerned that the company will lose money on the special order, which rightly so. We're going to sell it to these cats at $50, where we're usually selling it for $70. So let's do an incremental analysis. Since we're hotshot managerial accountants, let's do an incremental analysis of this Felter Company, all right? If we decide to reject the order, there's going to be no profit. We're not going to do it. But if we decide to do the order, 10,000 units at $50, that means we're going to have a $500,000 revenue. our cost is going to be $10,000 times the $45 manufacturing costs. We don't need to include the fixed manufacturing costs. That is already included, covered by the rest of the costs of the company. It's fixed. So that means our costs are going to be $450,000. The net income we're going to make is $50,000. Okay? They will increase their profit already by taking this additional order of $50,000 to accept the order. Here's a good follow-up question that could appear on the examination. I would ask, hey, why aren't we including the $10 cost per unit of fixed costs into this analysis of the additional sale to the foreign company? The reason for that, Mr. Hassey, is the fixed costs are sunk costs. You have those no matter what. They're $500,000. Your regular plant operations are taking that into account. You don't have any additional fixed costs with the production of 10,000 units to this special foreign company. So that's why you do not include them in the calculation. So the bottom line is this, is that the CEO of Felter Company should accept the offer because they're still going to make $50,000. Now, if this was a finance class or an MBA class, the next order of discussion would be, is $50,000 enough profit to do all this hassle of dealing with this foreign company? That's another side of the analysis. Here comes a couple of big words that you guys should know. This is what is called a quantitative analysis. It's looking at the numbers. If I would say to a student, give me a quantitative analysis, you would say, oh, Mr. Hassey wants an incremental analysis showing the dollars. But if Mr. Hassey asks, I would like a qualitative analysis, that would be an analysis where you would look at, is $50,000 worth the hassle of dealing with these people? All right. Is it bad PR? Is it good PR? What's the additional qualitative assumptions or opportunity costs associated with this? The good thing about this is we are not studying this in this course. We're just more concerned about the quantitative or incremental analysis of the bottom line of the numbers. All right, that was a paid political announcement for future use. All right, question 1, question 2, there are the solutions. You might want to check your work, and this is what I'm going to be basing my grade and my assessment on your quizzes when I post them later on this week. So if anybody has any questions or concerns about, I'm lost on this one, remember I have office hours for this class this afternoon from 1 to 3 o'clock, or you can send me an email, a text, or talk to me at another time if you have concerns about this material. But trust me, you are going to see 2 problems fairly similar to these 2 problems next Wednesday on our exam number 2, representing chapter 6 and chapter 7 work. Okay, there we go. That's that. Let's move on. Mason, give me a thumbs up. Do you see exercise 8.1a on your screen? Thank you, sir. Okay. So here's one of the, here's the problem A problems from chapter 8 that we're beginning to go over. We looked at some of the exercises the other day, and I want to take a look at a little bit of these problems. They look at 2 different areas. One is determining the unit cost, the target selling price, compute all the different costs involved with this problem. And this 8.1a is a perfect example. Note the word perfect, is a perfect example of a problem you may see on the examination next week. 8.1a. The solutions and solutions of the problem is now posted to Blackboard in week number 9. It is now posted. You can use that as your study guide. So again, this is a perfect example of what I'm trying to get your knowledge from knowing this situation. For example, National Corporation needs to set a target price for its newly designed product. The following data is relative to this product. There again, the 3 variable costs: materials, labor, and overhead. we have a fixed manufacturing overhead, we have variable selling and administrative expenses. Here's a question I might throw at you on an exam, just to see if you're sharp. What are the product costs and what are the period costs in this problem? What are the product costs and what are the period costs in this problem? Well, the product costs are materials, labor, variable overhead. The product costs are fixed manufacturing overhead. The period costs are variable selling and administrative expenses, variable fixed and selling administrative expenses. Those are the period costs. The product costs have to do with the production of the product. You never know, Professor Hasse might throw that one in just to drive you guys nuts. Okay, these costs are based on 80,000 units produced and sold each year. National uses cost plus pricing methods, we talked about this on Monday, to set its target selling price. The markup percentage on total unit cost is 40%. Here's what this will look like. One more time, Mason, give me a thumbs up. You can see this. Thank you, buddy. The reason I asked you, Mason, is you're at the top of my list and I can see you. All right, so what is our cost per unit? Our variable cost per unit are materials, labor. Here's the variable manufacturing overhead. The variable selling and administrative expenses, 80 bucks, all right? That's our variable cost. Our fixed cost per unit, our 1.440 manufacturing overhead divided by the 80,000 units, 18 bucks. Fixed cost administrative, 12 bucks, $30. Total cost per unit, $110 per unit. That's the answer. Remember, fixed has to be determined based on the volume of you're determining these costs on. There's my fixed cost per unit. Naturally, if we're going to produce more, these costs will go down, but variable costs will always stay the same, no matter what the volume is. So it's costing us 110 bucks to produce this product. You will see a question next week where you'll have to do this analysis. First of all, give me the breakdown of what is variable, what is fixed, what does it cost us to produce the unit. Then we go to part B. Part B of this problem tells us compute the desired return on investment for this company. The return on investment. If it's costing us $110 a unit to produce the product, we're marking it up 40%. Where did I get that from? The markup percent of the total unit cost is 40%. So we mark it up 40%. What's 40% of $110 cost? That's $44 desired ROI, return on investment. Part C, what is our target selling price? If it's costing us $110, we want to make 44 bucks. Our target selling price is $154. That's our target selling price based on cost plus analysis. What's the cost? $110. What's the plus? $44. That's our profit, 40% markup on cost. We're going to target it at $154 per unit. If we sell 80,000 units at $154 a unit, we're going to cover naturally our variable costs. We're going to cover all our fixed costs, plus we're going to be making a profit of 44 bucks a unit. That's at $154 a selling price. Part D asks us, compute the variable cost per unit, the fixed cost per unit, and the total cost per unit, assuming that 60,000 units are produced. All right? How does producing less change our target pricing? This is a good question because, not to sound like a boring professor, right now, many companies are doing this. All our budgets, all our pricing is based on 80,000 units that we can sell and produce. The economy goes into a recession. People no longer want to buy our product. Let's say our volume is estimated to go down to 60,000 units. What does that do to changing our analysis? Well, at $60 a unit, all right, at 60,000 units, we have our variable costs, we have our fixed costs. Notice our fixed costs now go from $30 a unit to $40 a unit. Why? Because we're paying less, we're producing less units. Our fixed costs will go up because we're producing less. Our total cost now goes to $120 a unit. So if we sell our product for $154 and it's costing us $120, we're going to lose $10 in profit because of the fixed costs being changed by the volume level. And everybody today in American business, from University of Laverne to In-N-Out Burger to the Los Angeles Dodgers to the Los Angeles Lakers, are now estimating, okay, if we do go back into work, how is that going to change our volume? Less attendance, less units, less hamburgers, less students. How does that affect our profitability and what we offer? We might have to change the selling price. We shall see. So problem 8.1a is a great example of those situations where we have to determine our selling price, and if things change, how does that affect our cost in relationship to our selling price? So put 8.1a at the top of your list for study for next week's exam, number 2, on April 15th. You will see a problem where I ask you to determine the cost structure, variable and fixed, determine the target pricing based on a return on investment prerogative, and then what if something changes? How does that result in changing our outlook about profitability? That's a very important concept, and a lot of companies are doing that as we speak in the real world right now. Okay, that was a good one. Let me have a sip of juice here. Cheers. Screwdriver. Nothing better to teach by. All right, that's a joke. That is a joke. It's not a screwdriver. Screwdriver is at lunch today. Okay, now let's go look at problem 8-6. Mason, you see this okay? Thank you, sir. Sorry to be a pain, but this is giving you brownie points for grading. So 8-6, Tanner, I only see the top of your head, so I can't ask you. There you go, that a boy. All right, thank you. All right, so here's 8-6A, and this is another example that I want you to be familiar with Chapter 8. Determine the minimum transfer price. Transfer price under different situations. Determine the minimum transfer price. A company is a division of another company. Produces restaurant pagers and other personal communication devices. These are devices sold to other divisions. Now, this is an interesting scenario. If I'm working for a major corporation, I might do my part of the corporation sells or provides materials to other parts of the organization. All right, you're kind of selling to yourself. All right, not exactly selling to you're producing a product that all of you are going to put together that you'll sell to your consumers, but you're also selling to each other. You're transferring those products to other parts of the business. That's what this means. So these devices are sold to other divisions within the company as well as to other companies outside. All right, this division was recently approached by a manager of the personal communication division within the company to make a special emergency response pager designed to receive signals from anywhere in the world. Who thinks up this stuff? The Personal Communications Division has requested them to produce 12,000 units of this special pager. The following facts are available. The selling price of the standard pagers to other divisions within the company or outside is $95. The variable cost of the pager is $50. We now know our contribution margin. Additional variable costs for the special pager. So if we do this special pager to this other organization within our company, it's going to be a special production, and it's going to have an additional $30 of costs. For each of the following independent situations, calculate the minimum transfer price and discuss whether the internal transfer should take place or whether the personal communication should do this purchases or not. Different situations for this company. Part A, the personal communications division is offered to pay $105 per pager. The CD division has no available capacity. The CD division will have to forego sales of $10,000 to existing customers to meet the special request. All right. So again, if we want to do this, we got to sell 10,000 less to people at $95, and we're going to at $50 per cost. And we're going to have to produce another 10,000 pagers at $105, but it's going to cost us $80 with those additional charges of producing. What does that look like? Well, it looks like this. Remember our contribution margin of pagers at $95 a unit, and so on. Let's go back to this. Remember, $95 is our selling price. Contribution margin is $50. The additional pager is $30. So I go back to this. In other words, we're having a contribution minimum marginal cost with the 10,000 pagers at $80. What would, and the opportunity cost would be $95 minus 50 times 10,000 divided by number of pagers, $37.50. Therefore, the minimum transfer price would be the $50 plus the $80, plus the $30, excuse me, $80, plus the $37.50. Since this is a higher transfer price than the since this is higher than the $105 transfer price of the other pager, the CD division would reject this offer. In other words, the price is going to be higher because of that $37.50. Now, where am I getting the $37.50? The $37.50 would come from the additional cost of producing those at that special price. Transaction B. The communications division is offered at $150 per pager. All right. What would that work out to? They give us a little answer here in their textbook. That would be $140, because we're going to be adding $60 to that cost, be based on the additional units to be purchased. Therefore, the transfer price would be $140. The $80 plus the $60 of the additional cost of producing those. Since the transfer price offered of $150 exceeds that, they should accept the offer. Now, the reason why I'm showing you this problem is not so much I'm going to ask you on the exam to explain or to calculate the transfer price or do any of this. You're not going to have to do that. The calculations from Chapter 8 will be 8.1a. The only reason I'm showing you this problem is I want you to be able to tell me, what does it mean by a transfer price? What is the definition of a transfer price? What makes up a transfer price? Because you're producing an additional product at an additional cost. How does that change the cost and the pricing of that product? What do we mean by that? And that'll probably be a multiple choice type question. But I need you to know the definition of a transfer price. Do not worry about the definition or calculations of a transfer price. Problem 8.1a is what you need to be concerned about for calculation problems from Chapter 8. And also, it wouldn't be a bad idea to look at exercise 8.5 and 8.3, which we did the other day on Monday. So those are our review problems that, again, you do not have to do, but they set the stage for your examination for next Wednesday. So you have your quiz number 2, problems from Chapter 6 and 7. You have these problems that we're reviewing today and this week from Chapter 8. and we'll look at other problems from chapter 9 on Monday. And so these are your review problems for that work. Now, speaking of Monday, I want to show a brief video introducing Monday's work, chapter 9. It's called budgeting. Now, the reason why I'm giving you a little bit advance on this is I know many of you are never going to do managerial accounting in your life. I know that. Okay, so these calculations of target pricing, of variable cost, fixed cost per unit, a lot of you will never do. But here's something that every one of you will do in your life, no matter what job you do, and that is budgeting, planning. I was talking to one of our athletic coaches the other day, and we were talking about the future of athletics on the campus and that sort of thing. And I said, I said, Coach, how has your life changed? Well, 2 areas. I'm recruiting less, or recruiting via online, and my life has changed because I'm doing more budgeting. Here's an athletic coach worrying about doing more budgeting. Why? Changing the different plans or different expenses of what the academic costs and what the athletic costs are going to be in the future. The budgets will change. All of you will participate in the budget process. By the way, this coach for Jake and Paul, our golf coach, even though he's not coaching now, he's doing a little recruiting. He's spending most of his time redoing his budgets for when the team comes back to campus. Everybody works on budgeting, and it's a very important chapter. I think chapter 9, besides the first couple of chapters, is the most important chapter of our course, because this is where you all will be using down the line, all right? Down the line in your career, down the line in your business program. So let's take a look at a quick little video that introduces that pricing. Now, these videos are kind of dorky, and I apologize. But the guy who's doing this video is the guy who wrote this textbook. Yes, there is somebody that demented in the world. And the author of this textbook is the writer, or is the person giving this little introductory video to chapter 9. So let's take a look at that. If I can find it. I'll find it. There it is. Mason, you see what it says Wiley on the screen? Okay. Here we go. Let's play this video.
In this chapter, you'll learn the basics of how to prepare a budget. Preparing a budget.
All right, time out. Does this guy look like an accounting professor or what? Tell me, this guy is 100% managerial accounting. If we could be making a movie about managerial accountants, this is the dude who'd do that. Okay, here we go.
Budget is of vital importance for running a business. It is very difficult to achieve your goals if you don't have a plan for getting there. The budget is management's plan for getting to where it wants to go. That is true no matter what type of organization you are running and no matter what size. Even a one-person operation benefits from laying out a formal budget. You will see that a budget is actually a collection of individual budgets. For example, a manufacturer prepares budgets for sales, materials, labor, various overhead costs, production, and others. While all of these are important, it is probably safe to say that for most organizations, the cash budget is the most important. When businesses fail, they fail because they run out of cash. You might be surprised to learn that sometimes businesses have rapidly growing sales and yet they go bankrupt. How can that happen? It is because they didn't plan for their cash needs. You can avoid having that happen to your business by learning how to do a cash budget. It will even help you with your personal finances.
Wasn't that exciting? Okay. But that brings up a couple of points that I want to mention leading into chapter 9. That guy really was the writer, the publisher, the writer of our book. He really was. Okay. Mason, can you see the blackboard on your screen? Okay, thank you. All right. First of all, this is what I want you to concentrate on in your reading for chapter 9, the cash budget. Spend your time on learning and looking at how they design a cash budget. Also, the definition, not how to do it, but the definition of what is called a master budget. But the cash budget is what we're going to look at next week as far as how to put that together. There's nothing more important for a business to make sure they plan and account for and know how much cash they're going to need, how much cash you're going to provide in the future, the cash budget. That's what we're going to concentrate a lot on, and that's what's going to be on your exam 2 next Wednesday, the cash budget. So please, in your reading, in your looking at the PowerPoint, in my introduction video this coming Sunday, I will concentrate on the cash budget, and that's what you should concentrate your reviews for, okay? Make sure you study that because that's the most important part of the budgeting process for this class. I know some other professors might have you do a production budget and blah, 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 but if you're not a full-time accountant, but you're running a business or you're being a supervisor or a manager of a department, the cash budget is huge, and you need to be aware of how to put that together and what it tells you as part of your managerial strategies, what your cash budget is. The CFO of University of Laverne just yesterday sent out a memorandum to its staff and faculty. The cash budget has dramatically changed at Laverne due to the nature of the institution handling the coronavirus, and he has to reassess the strategies of the university. The cash budget is the first budget you go to when things are changing, and that's why we're going to study that and look at examples of that next week. Okay, now let me bring up everybody here so I know who's here today so I can make sure I got everybody covered. Let's see. Okay, I think I got everybody. We're missing a few more people today. The reason why I do this, guys, and I know I'm recording this, the reason I do this is because if I find that you guys are losing engagement in this class because of the world that's going around you and you feel that, oh, I don't want to worry about managerial accounting, I got other things to worry about. I need to monitor that, and I need to make sure that you guys stick to my plan, but also that you guys are being taken care of. I had a conversation this week with one of our students, and this student just told me, Mr. Hassey, I got other things to worry about than managerial accounting. Okay, I understand that, and I appreciate you telling me that, but at the same time, we must be aware that you want to complete your college education. You want to get the hell out of here. And this is one of those steps that you have to do. But also, if you are being pushed and stressed by other things going around in your families, you let me know about that. Just don't not show up and I don't know what's going on. Just let me know how you're doing, what I can do to make it better, and also what I can do to make sure you guys can get out of this class with what you should know, with a decent grade, and we can move on. And hopefully I will see you all on campus next fall, and a lot of you will be taking the practicum program, and I'll see you all live, and we don't have to do this stupid stuff anymore online. For example, speaking of, thanks, Mike. Speaking of this, check this out. I did this earlier for the other class, so sorry, Tanner. If I had my way, I would be here as my background for this class. Check it out. By the pool in Palm Springs. Cameron, wouldn't you rather be in the pool in Palm Springs with a couple of nice Diet Cokes by your side and you're hanging out, just got done with a round of golf, little tennis, little jacuzzi action? See, this is where we want to be. So let's finish this up, and by next fall, we'll be back doing this again. And I can not have to do this virtual make-believe, and I can actually be in Palm Springs next year. Okay, so that's a little bit of goofy stuff. All right, I hope everybody is well. I'll let you loose. Again, for Monday, you have no graded work this week. Monday, you are going to reassess your quiz grade as I post the grades. Make sure you're up to speed and feel comfortable with that. Monday, you're going to be reading Chapter 9, concentrating on the cash budget, and getting prepared to getting all your notes and problems organized for our exam a week from today, April 15th. Now, understand this, sports fans. The exam will be take home. You're not, we talked about this on Monday, you're not sitting in class in Landis Hall and you have an hour and 15 minutes to do it. This is a take home exam where there's going to be a little bit more intensive study and planning because you have time to do that. And so just make sure this exam probably would take you about 2 to 2.5 hours to do at on a take home level. And just so you're prepared for that, make sure you have all your notes, all your templates, all your examples together, because I'll be pushing you a little bit on your knowledge of these subjects of chapters 6 through 9. So again, if you have any issues and want to talk to me directly, my office hours are this afternoon at 1 to 3 on Zoom. If you want to come by and say hi to me or let me know what's going on or I can help you, give me a holler this afternoon. Or if it's Palm and other people in our class, it's in the middle of the friggin' night and you have to do that then. So sorry about that. Besides that, be well, be safe. This is a key week and next week. If you're going out, don't wear a face mask. Wear a face mask. Don't wear a face mask. If you're going out, make sure you avoid all those other idiots out there who spread diseases. Stay away from them. Be well, people. Anthony, did you have a question? Okay. All right. Be well, people. Zinja, take care. Mike, be careful. Carlo Andre, welcome, Carlo. Chris, good to see you, buddy. Denise, I saw Celeste here. Good night. Hello, Celeste. So everybody, you take care. We'll see you all from the pool side next Monday. Ha ha. Adios. Take care, everybody.
Thank you, Professor. Take care of yourself.
Thank you, sir.
Have a good one. Bye.
You too. Be careful.
You too. Thank you.
Thank you,
Mike,
Professor.
Mike, what's with the picture? You look like a model. You're modeling clothes. What's very impressive. There you are. Okay.
Thank you. Thank you.
All right, Mike. Take care.
Bye.
Bye. See you, Aiden.
Hey, Professor.
Yes, sir.
Super silly question.
Go ahead.
One, do you believe in like astrology?
Do I believe in astrology? No, I read my my horoscope every now and then, but I'm not. I kind of don't pay much attention to it. No.
Okay, what's your sign? I just wanted to know.
My sign is Leo.
You're a Leo. Huh,
Yeah.
cool. I just like knowing all like my teacher's signs. I don't know why. It's just like.
Well, that's ours also. I'm a Leo, and a lot of my friends or even my wife say, you know, you act like a Leo. You are.
I can see it a little bit. It makes a little sense. I see it.
All right, Aiden.
All right, take care, man.
You take care.
Bye.
Adios recording. Poolside. Not bad, huh?